video, we will be going through our RSI indicator trading strategy in depth and how we use it in combination with price action. We also want to take the time to thank you all for your continued support in helping us get our YouTube award. So let's start the road to 1 million. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. So, two very important points before we start. First, indicators are not magic, and we never use indicators on their own for trade entries. We use indicators to support what we have already established with price action. And second, everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action stays relatively consistent across different assets. So, we're going to go very in-depth in this video. So here's a quick breakdown of what we will be covering. First, we'll go through all the core concepts to get everyone on the same page. Then we're going to go through the strategies section. And finally, we will show you how we used all these concepts to take trade entries on Tesla and Apple during the big market pullback. So strap in, as we have a lot to cover today, so let's get into it. So, what is the RSI indicator? RSI stands for Relative Strength Index, and it's an indicator that you apply to your charts that is often used for identifying overbought or oversold markets. So let's apply the RSI to our charts. At the top here, click Indicators. Type in R, and it'll show up right here. Click Relative Strength Index, and then it will be applied to your charts along the bottom. Now, this line here is 70 on the RSI, and this line here is 30 on the RSI. Everything at or above the 70 line is what we call the overbought region. Everything at or below the 30 line is what we call the oversold region. So in relative terms, when the RSI line touches the 30, just like it is right here, it indicates that the price of the asset you are looking at is cheap. When the RSI line touches the 70, just like it is right here, it indicates that the price of the asset you are looking at is expensive. Again, this is in relative terms. So how is the RSI indicator traditionally used? Now, this is what most traders do. When the RSI enters oversold, they'll start buying and entering long positions, expecting price to go up. When the RSI enters overbought, they'll start selling and entering short positions, expecting price to go down. Now, here's the problem with using the RSI indicator like this. Notice how at this level here on price, the RSI has already entered oversold. So if you started to buy and enter long positions, price would have continued to go against you for quite some time before it finally reversed. What this means is, in heavily trending markets, the RSI indicator can stay inside of the overbought or oversold region for a long time. And if you keep taking trades solely based on the RSI indicator, expecting price to reverse, you will most likely rack up a significant amount of losses. So this then leads us to a question we often get asked, which is, how do we use the RSI indicator where it actually helps our overall analysis? Also, right now, comment below and tell us what video topics you want us to cover, as we always look at the comments to decide what to create next. Now, we use the RSI indicator in one way and one way only, which is combining RSI with divergences, or RSI divergence. So, what is divergence? Divergence occurs when price is moving in the opposite direction of the RSI indicator, which can then be used as an early indication of a possible, keyword possible, trend change. So in this uptrend here, price made a higher high, but on the RSI, it made a lower high, which created a divergence and resulted in a reversal of price. Again to the left, price made a higher high, whereas the RSI made a lower high, which created a divergence and resulted in a reversal of price. So going in the opposite direction. In this downtrend, price made a lower low, whereas the RSI made a higher low, which created a divergence and resulted in a reversal of price. Now, divergence can be used in many other indicators as well, one of which is MACD, which is popular amongst many traders. So this then leads us to another question we often get asked, which is, why do we prefer to use the RSI indicator over MACD? Don't forget to comment your questions below. Now, the reason is simple, and it's because the RSI indicator gives us a more precise and clear divergence formation, which results in higher quality trade entries. Here is the exact same chart on both sides. On the left and below is the MACD indicator applied. On the right and below is the RSI indicator applied. Notice how on the RSI here, it gives us a very crisp and crystal clear divergence formation. But now, if you look at the MACD, there isn't a divergence signal at all. And this is an issue we often experience with the MACD, which is a lack of or low quality divergence signals. Now, let me be clear, there is no right or wrong choice. Both work perfectly fine. We just prefer the RSI because it works best with our overall strategy. And MACD might work best with your overall strategy. Neither is better than the other. Because above all, indicators are not magic, and we do not use them on their own for trade entries. We use them to support what we have already established with price action. Now, that being said, if you know how to use divergences correctly, it is one of the most powerful tools for spotting and confirming high-quality reversal trades, and you'll soon find out why. So let's cover the types of divergences we look for. Now, there are many kinds of divergences people use, but here are the main two types that we look for as part of our RSI strategy. First is wide divergence, and second is tight divergence. And under each type, there are two subtypes. Subtype 1 is when the divergence occurs at or inside of the overbought or oversold region. And subtype 2 is when the divergence occurs close to the overbought or oversold region, but does not touch. So let's go through the first type, which is wide divergence. Wide divergence is exactly what the name states it is. It is divergence where its swings are very wide and very obvious to spot on the charts. Here is an uptrend. We had our divergence, which then triggered a reversal. Notice how wide these swings are, hence the name wide divergence. Same thing in a downtrend. We had our divergence, which then triggered a reversal. And again, notice the clear, wide swings and wide divergence. So how do wide swings relate to price action? Wide divergence is also what we call high quality divergence, because we like to see wide swings and price moving sideways before looking for any kind of reversal trade, because it tells us that the side in control of the dominant trend before the reversal is no longer in complete